What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, welcome back, everyone, to another episode of the Long Game Podcast. Today, we're joined by Broc Buckles. So if you're a longtime listener, Broc's been on here a number of times. I don't know, maybe even 2 or 3 years ago was the first time, probably the earliest guest. But Broc has this really cool background where he used to drink the Kool-Aid and work at a Northwest Mutual and just sling insurance left and right like everybody else. And then he just, was one of the smart ones, and at a young age kind of had the slap in the face. I was like, I just don't think this is the right way to do it. And so he launched BC Brokerage with Pete, his partner, who we're all really good friends. And basically what they do is they help people like us get insurance for our clients. So I'm not a big believer that there's only one right model of being a financial advisor, but in my mind, for me, I don't really want to be selling anything. I want to sell, we're here to help you. We're here to help you make all the right decisions, and we have all the right partners to get everything that you need. And so I think, Broc was the first one to think about this, where in the finance world, we're basically the doctor and they're the pharmacist, right? So our job is to figure out, here's what you need. We can leverage them if we need help in certain areas. Their job is to go find the best policy, the best carrier, et cetera, for them. And so, Broc knows a ton about the insurance space. And so we thought he'd be the perfect one to come on to talk about life and disability insurance. And this one's going to be about life. Anything you want to add, Broc?
No, man, you might describe what I do better than I describe what I do. That was really good. No, I think that's a really good synopsis, man.
Okay, perfect. So life insurance is obviously this huge world, right? We have everything from term all the way to basically investment products that some say aren't investments, some say that are. So let's just first start off with give us the overview of the area and give us just the different options people have.
Yeah, so I think you can really separate them pretty distinctly into two separate categories, right? So the first one is term, very, very simple. Basically, you're exchanging a dollar amount. You're paying the insurance company a premium every month. If something were to happen, they pay the death benefit, whatever that is. There's really not much beyond that. It's for a period of time. So 10, 20, 30 years, sometimes 15 years. But it's like, as far as life insurance is concerned, it's as simple as it gets, term insurance, right? Then the other kind, permanent insurance, there's multiple kinds, but generally these are for life, right? So you're going to have them for your entire life. Some have cash value, some don't. And so those are your guaranteed universal life, indexed universal life, whole life insurance, are just a few types. But yeah, those are the big two categories.
Perfect. And we'll spend a bunch of time, or at least 5 minutes or so, just hitting on those main areas. I don't think we need to be here's when you need universal life by the end of this by any means, but at least
Right.
You're aware of kind of some of the use cases and why it exists. But I think best place to start on term is just and even life insurance in general is, how much do you need, right? And how do you think about this?
Yeah, absolutely. So, I mean, when you're working with your financial planner, they're going to have a pretty good idea about what your overall picture looks like, what your assets look like, all of that. But when people ask me this question, I think there's a pretty good general rule of thumb, right? And I kind of call them the big three that people should think about. One is paying off debt. Two is thinking about kids' education, right? So do we want kids to go to private school, K through 12, and then, go to a private college? Are we cool with public school? So planning for that. And then the third one that people tend to think less about, I would say, is continuation of lifestyle, which is just a really fancy way of saying, if something were to happen to you, how many years do we want to replace your income for the surviving spouse to allow everything to continue running smoothly? So I think those, as a general rule of thumb, are a really good place to start.
Yeah, I think it is a really good place. And I think a lot of times when you talk to people who are just in insurance, they miss out on the rest of the picture, right? They basically look at what's the most amount of insurance I could possibly say that you need and tell you to get that. And I think that's a little bit misguided, right? I have a client who, they're basically they could retire tomorrow if they wanted to. They don't need to look at future earnings, right? You could say, hey, if you want to say you make $1 million a year and you're probably going to work for another 25 years, so you should get 25 million. Sure. But if if you could retire, if you could pass away today, your family could live the exact lifestyle that they want. That insurance need is very different. And so if we
Yep.
blend this more towards the middle, you do have to look at net worth, right? Like you have to look at insurance everywhere. You have to look at what your net worth is. You have to even look at like what would be the shortfall if you were not here, right? It's very common today to have dual income households, right? And so you could say, okay, great. Like if I passed away, I would want my spouse to be able to not work for a few years, but like I know them, there's no way that they're not really going to work. Okay, great. So what's missed earnings? What would now our shortfall be on a yearly basis with just that one income? And then how does our net worth and everything else elsewhere come in together? And I think that's where like life insurance is everything, right? It's net worth, it's income, it's potential shortfall. It's made the things that I would be weary thinking about is like inheritance, right? I've heard people say like, well, hey, I know that like we're going to get inheritance in the next 5 or 10 years. Yeah, but what if you pass away and that's your parents and your parents decide they want to give it to your siblings instead of my spouse, right? Like those are question marks, those are unknowns, but life insurance, I think, has to be that blend of all of them. It's not just you make $1 million a year, you're going to work to 70. Okay, you need $40 million of term life insurance.
Yeah, no, I completely agree. I mean, I think that's why when people try to use the general rule of thumb philosophies like a multiple of income, or, if you're coming out of this situation, or if you're a doctor or whatever you're doing, like this is how much you need. There tend to be a lot of general rule of thumbs out there, and it's not specific to the individual's needs. And like you said, I mean, there's a lot of things that come into play. If you're talking about someone who's already done really well, they're in the mid 30s, they've sold a business, they're worth millions of dollars. And maybe they start another one, right? Now they own another business. Somebody else owns another business, but the amount of money that they have stowed away is completely different, thus making the life insurance need completely different. So it really has to fit in the overarching financial plan.
Well, I think the one thing that everybody's brought up here a couple of times is the plan, right? I think that's the biggest issue with the insurance industry as a whole, is that it is a product that 99% of people need, gets often sold in a way that doesn't actually benefit that person in the way that it should. And I don't think that oftentimes it's because somebody's trying to do any harm. I think oftentimes it's because they just don't have all the information, right? Like if you come in and all you're looking to do is solve for this insurance need, and you meet with your insurance professional and you guys meet one time for 30 minutes to go over what your options are, there's no way for them to be able to understand, okay, what are all the nuances of my situation? And one thing that we just touched on was, I think oftentimes people think of a spouse, right? The working spouse, or if it's a dual income, but let's use the example of like one spouse is working, one spouse is at home. Yep. I'll just use myself as an example. If something were to happen to my wife, Kristen, like there is a ton of expenses that have to be covered that has nothing to do with her earning income outside of the house. Because I always say like she has the hardest job. She takes care of our 4 kids. And the reality is she allows me to be able to do the things that I'm doing. And if she wasn't there, there'd be a lot of costs involved with doing the things that she's doing. And this is where I think just ultimately you have to plan before you go in and you try to solve any problem. And that's the same true for life insurance as anything else.
Yeah, I think that's one of the biggest missed ones, right? And honestly, just being underinsured is a big one. I still, maybe 50% of people I sit down have no life insurance outside of work. So like, obviously that's an issue. And then most that do, they either kind of got sold permanent insurance and they still have nowhere near enough, or they're like, have like 2 times salary, right? If you make $500K and you have $1 million of coverage, you're going to be able to pay off your mortgage at best and have no income replacement. And then the other side, right, the stay-at-home spouse, this again depends on your wealth level, right? If you have such a large surplus and you have a ton of wealth, like stay-at-home spouse is a valuable role. You might be able to hire it out and be fine. But in general, if you have 3 young kids and they need to be able to get to school, get picked up from school, get to activities, maybe some aren't in, you might be looking at 60 to 100K a year. And if you definitely don't have enough surplus to pay for your life, invest and do whatever, you need life insurance to protect against that.
Yeah, 100%. I think to kind of go off of that as well, I always tell people life insurance planning is a lot more once-based than people understand, right? Like everybody wants to talk about the needs. That's really great. Like a financial planning software might not say that a stay-at-home spouse needs a replacement of whatever. Yeah, sure. But when you get into it and you say, okay, but yeah, we're sending them to this childcare. They really love their friends there. Like we really want to keep them there if something were to happen. Then all of a sudden, okay, what, or replace them staying at home, but we'd like to be able to send them this childcare, right? This is how much it's going to cost a month for 4 kids. All of a sudden, the stay-at-home spouse is worth a lot more than what a financial planning software is going to spit out. So that one space piece, I think, is huge.
Well, I think it's just also, it's really unique to the individual. It's really unique to the family. And it takes somebody having, whether it's the financial advisor, whether it's the insurance professional, whether it's a mix of both, having really in-depth conversations to understand, like, okay, if something were to happen, and this is a situation that nobody wants to talk about, but the reality is, like, we're there to plan in case that day does happen. Okay. And if that day happens, what are the things that you guys would be most stressed about, right? If you own a big house and you got a big mortgage on it, and you're like, man, if that happened, like, I want to make sure that we get that paid off. But on top of that, like, here's these upcoming things that, like, I've been thinking about. I really want to make sure that, like, we're able to do those things. And it takes actually sitting down and thinking about it, because oftentimes we live in this go, 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 go world where Monday through Friday you work, and then all of a sudden on the weekends, maybe you have kids, family things going on, you're continuing to build your business, whatever you're doing, you're never actually sitting down and thinking about these scenarios. And it's really important to sit down and think about it, and then go to somebody like Broc to understand, okay, how do I need to solve this? Not only from a needs base, but also, Broc, to your point, from a wants base. Like, what are the things that I would want to have happen if this day came?
Yeah, absolutely.
Really good points. So 2 things I want to hit on. So one of them, before we go into use cases of life insurance outside of purely what we're talking about, I want to talk about times you need to reevaluate. So I think that's really important, right? A lot of times I think people get their life insurance and they're like, done, right? Good to go.
Right.
Check that box. But in reality, there's a lot of times you need to reevaluate. The most common one is kids, right? If you didn't have any kids, now you had a kid, or you had 2 or 3, that's a really good time to review your life insurance. Another time is you buy a bigger house, right? If your debts go up quite a bit, you're going to need quite a bit more life insurance. On the flip side, there's times where you're actually going to need lower, right? So lower could be, my kids are now out of the household. Do I still have that same need? It could be post a liquidity event, some way that your wealth grew a ton and you decided that you don't. And then another time you might need to add life insurance is, oh, wow, I have a lot more wealth, and now I might have an estate tax issue, and now I might need life insurance to help pay estate taxes. And I'm sure I'm missing a few in here. Do you guys have any time?
Yeah, I mean, no, though you covered the big ones. I'd say, getting married, I'd say, is a big one. Job changes, where maybe you were relying on some of those benefits through work, and now portability might become an issue. Say you're at a big company that offers fantastic benefits, you're switching over to a startup for a lot of upward potential, but maybe those benefits aren't what they were at that last corporate position. But no, I think that you definitely hit the big ones.
So let's talk about, you go.
Well, the only other one I would add, Thomas, is just making sure that you have the ability to get life insurance in the future. So one thing that we do, and this is kind of specific to our situation, but like for a lot of young athletes that we work with, like they don't have life insurance when they're coming to us. They might be 18 years old. And frankly, they don't really have a need for life insurance today. But the reality is we can ensure that future insurability by even getting some sort of small term life insurance policy. Because again, we don't know what's going to happen in the future. And Thomas, to your point, like we've been talking this whole series on risk, we're trying to avoid things that like we don't know are around the corner. So if we can pay a small premium to avoid that potential risk in the future, and you do not need to buy a permanent life insurance policy to do this, you can do that. So that's the other potential opportunity that I would say is out there for people as they're thinking about life insurance.
And I think that one's really important, and I agree with it, but I hate it, right? Like I absolutely recommend that to people. I did it for myself, but I hate when you boil this down to, I'm getting life insurance, or I'm getting insurance so I can get insurance. Right? Like that just, when you boil it to what that really is, that line is like, oh, that's so annoying. But in general, it does make sense. Like I've probably worked with at least 10 people who are uninsurable, and they didn't work with us before. They're new. We can't get them life insurance. And so this is a really big risk and a really big gap that, they probably need a higher savings rate. They need more on the other spouse, even though that doesn't necessarily cover it, right? Like you have to think about your finances a lot differently when if I were to pass away tomorrow as the high income earning spouse, my family would be in a really tough spot. Sure, you can buy as much as you can through work, but that typically caps out pretty low.
Yeah. Yeah, I saw your face when he was talking, Thomas. You're like, yeah, that's not my favorite concept ever. But it is true, man. I mean, we call that concept guaranteed insurability, right? And it's one of those things to where we've seen people come to us and they get preferred plus best rating, right? It's like literally $1 million. They're paying like $50 a month, next to nothing, right? For a fair amount of leverage. And then unfortunately, a year goes by, they're like, appreciate it. Glad we had the coverage. But then they send me an urgent email and they're like, hey, we're interested in get that coverage all of a sudden. And then I know anytime I get one of those emails, we're thinking about something health related. And turns out that individual was having a health problem that was going to be at least 5 years before we could even have a shot at getting the insurance again. So yeah, not a fun concept to think about having insurance, like you said, for the sake of insurance. But we have seen time and time again, unfortunately, it does happen.
And you lose if you don't bring it up, right? If you don't bring it up and it happens and you knew that, like, you are liable, right? Like, so my thing is, here's the facts. This is a risk that you face. How do you think about it? If you're not worried about it, you made that choice aware of the facts. For the low cost, I'm going to choose to get it, right? Because I would rather know my family for sure has insurance coverage than not.
Yeah.
All right. But the one thing I would add is the reason why I think this gets a really bad rap in the community is because most of the time when this is getting pitched, they're getting pitched some sort of whole life insurance policy,
Totally.
which we're going to talk about permanent policy. Right now, guys, we're talking about term insurance. So we're covering a need at a very low cost to cover that need. A lot of times when people talk about future insurability, they say, oh, well, you got to get a permanent life insurance policy so it can stay in force forever. But the reality is, if you get a properly structured term policy and something happens to you along the way on that term policy, you can always flip the dial and make it into a permanent policy, which we're not going to get in the weeds about today. Yeah. But I just think it's really important to understand, just because you need the insurance doesn't mean that you have to buy some sort of permanent insurance policy that's going to be enforced for the rest of your life.
And you need to know on that, right? Like, you should look for permanent insurance riders on your policy. A lot of policies, it does not equal. It's not 30 years and 30 years you have the option to convert. It might be 10. So that's definitely one thing that you want to look at. And a couple other things I want to hit on really quick. One of them is, like, through work or external, I'm pretty much always a fan of going external. Take the minimum that's at work, buy external. That's going to stay with you throughout the term. That exists. Sometimes your work policies can be portable, but what I see a lot of times, if you're young and healthy, you're actually probably paying more through work. If you're old though, or maybe you're uninsurable, it might be better to get through work because it's cheaper and then supplement the rest. But it is a pretty risky strategy to say, I'm going to buy $3 million through work, and all of a sudden you leave, it doesn't come with you. And we go back to this insurance side, insurability side of things. If your health is going to be different and you're going to be older, that's, you might not be able to get it, or it's going to be really expensive than if you locked in that term.
Yeah.
One other thing to add here, because I've been seeing it a lot, is, a lot of people end up with insurance from Northwest Mutual, and Northwest Mutual does have good insurance. But one thing I see is that a lot of people do this term to 80 versus regular term. And in my mind, I think this is something that you want to avoid. The reason why you want to avoid is it looks really attractive because in the first 5 years it's cheaper, but it changes. It gets more expensive because every year you're basically, what's your new age? What's your mortality? And so all of a sudden, 10 years into your term, where you maybe still have young kids, or 15, 20 years, it becomes super, super, super expensive. And without hating, they do that because they know you're going to see that and then want to convert that to permanent life insurance. We all know that's the thing. So you can use them, but ask for level term, right? Because level term says, I'm getting $1 million, I pay $50 a month. For all 20 years, I pay $50 a month. That's what you want to do. And it becomes cheaper every single year for you. I mean, we're not in a deflationary world. We're in an inflationary world. So fixed fees that stay the same over 20 years are going to end up being better.
Yeah, absolutely. Well, sorry, Jacob, go ahead.
No, go ahead, Brock.
I was just going to say that, well said. And yeah, that's the thing. If you actually look at one of those illustrations, and, like I said, I worked there for a period of time. So actually sold those. But, when it's, first 20 years, sometimes not terrible, right? Anything past 20 years, and especially if you look at like what the prices look like when you get 60, 65, 70, it goes from initially when you bought the policy, it was $600 a year to literally being like $12,000, $15,000 a year. So it's a massive difference. And then, yeah, the understanding is always going to be, and a lot of them explain it to you ahead of time, that when we meet year by year, we're going to convert little pieces of this $1 million or $2 million policy over to that permanent policy. And they've got all these fun analogies, like there's a warehouse and the warehouse is term, and then we're going to fill it up with whole life pallets and all this other stuff. But yeah, definitely a good idea to watch out for that stuff.
And again, for me, like, I'm not hating on any advisors there. I know there's good advisors there. Yep. Just in general, these are things to look out for. Okay, let's talk about, do you have something you want to add, Jacob?
I have a lot to add about that, but the only thing I would add is this. There's a lot of really good insurance pros out there, like guys that are they are experts in their space. You want to find somebody who is an expert in their space that can help facilitate whatever your problem is and solve your problem. Okay. The other thing that I would add, it does not hurt to have somebody in the room that's not getting paid on the insurance. Is that a prerequisite for making a good decision? No, but I think that does help a lot in the situation. I think about for us, when clients are buying insurance, like I don't really care if they buy the insurance or not. Like we're not getting paid any differently whether they buy the policy or not. I'm here to recommend the pros and cons and provide whatever we think the really good solution is, whether that's through Broc or through somebody else, to make sure that clients have their needs solved. So I would just encourage everybody out there, if you're buying an insurance policy, even if that person isn't in the room with you, maybe run it by somebody else that you know that you think maybe has some experience with insurance. Like, hey, what do you think about this? Just to make sure you're getting another opinion on it.
Yeah, absolutely. So let's think about together use cases of term, and then we'll kind of go in the last like 5 minutes of permanent, and we'll just each say one and go around. I'm going to start, and my first one is just going to be, protect your family, right? If I were to pass away, I want to make sure that my family is covered.
Yep. I would say term could be a really good use for term. We use a lot of term for buy-sell agreements and collateral assignments on businesses.
Yep.
Yeah. I just think future funding, right? Big expenses that are coming up. The biggest one that I always think about is like educational expenses. Broc, you mentioned that at the beginning, but starting to think through like education is a lot more expensive than people realize. And if that's something that you want to fund for a future generation, term can be a great way to be able to do that if something were to happen.
Yeah. And I don't know if you guys still have a bunch more, but the ones that I can think of is key life. So like, hey, if me and somebody else are running a business and that business is not going to run as well if I were to pass away, for your key people, you do want that, right? Because if they were to pass away and you're going to take a hit, that can help you hire, and just kind of have some time to improve as a business.
Yep. That's well said, man. You had a great post about that today, actually. I think it was today, right? The good commercial business insurances.
Maybe. It's all scheduled. I don't know what
It was scheduled. But no, I think that's a big one because a lot of people don't understand that there are, if you have a high performing salesperson and they're responsible realistically for, 20, 30% of your revenue. And if you lose them, they kind of own the relationships. Well, it's going to take some time to recover and be able to, it's nice to have that influx of cash into the business and give you some time.
You'll find it for like head of sales, maybe CTO, CEO, like maybe your chief legal officer. Like some of them that are like, you're valuable, but we can hire. It's a skilled role, potentially not. But I do think that's a really important one. I'm trying to think. The other one's like, hey, if you take an SBA loan, most likely they're going to require you to have life insurance on yourself for the value of that loan. And then some of the other ones like, hybrid long-term care, paying of estate taxes, like technically you could do that with term, but both of those are, especially long-term care, but most likely estate taxes are going to be permanent. So let's go into permanent. Let's have you kind of just hit a key summary of each one. Once each one's done, we'll chime in something and then we'll move to the next one.
Yeah, definitely. So I guess we could start with the one that a lot of people know about, which is whole life insurance, right? Which is essentially there's a death benefit, but there's also a cash value. So part of the premiums that you're using to pay into the policy are for the cost of insurance, and then part of the premiums are going to that cash value. And so essentially there's that account, the dividends from the company basically go back into the policy a lot of times. If you do paid up additions is what they're called. So the pitch on these is that you have the permanent insurance policy, but you also have a cash value that you can borrow from if you need to do that. So that's kind of a general overview, high level.
You could do a one pay where you fund the whole policy of your whole life one time. You can do it over a few years, 10 years, whatever. But in general, I still see the average person is doing monthly. And the biggest reason I actually don't like permanent life insurance is like, again, I have a new client who comes in, they're paying $30K a year for permanent life insurance right now. When they're real estate investors, they haven't invested much here. They'd be better off taking those premiums and buying more real estate on a yearly basis. They still don't even have close to enough insurance. Because again, if you're paying, let's say $50 per million of term, throw that out the window, right? To get $1 million of whole life, if you want to have cash value building in any of these permanent life insurance policies, it's going to be pretty expensive. But, I've seen this where people are 4 years into a policy, they decide they want to start a business and they're like, how can I make $30,000 a year in premiums when I want to start my business? So you either get rid of it and pay surrender charges, or you don't get to make that decision that might have been best for your life because you're stuck into something that's fixed and at a high amount. So big reason why I don't love it, but it is still good in my mind for estate tax planning, there are the people who say like, it is uncorrelated, different than, it can fill part of the bond section of your portfolio. But again, you still have that cost of insurance, which can get, expensive over time.
Yeah, and I would say it's not a replacement because a lot of people want to place it or pitch it as a replacement for 401ks and IRAs and stuff like that. It's definitely not that. Like you'll see videos all the time on TikTok. They're like, this is what you should be doing instead of your 401k. Like, no, it's definitely not what you should be doing. The infinite banking stuff is another concept. I will just tell you from the insider's perspective, every time that I've ever heard anybody talk about infinite banking or being your own bank or anything like that, for the most part, they're talking about how much commission that they make off selling those policies. So,
well, totally. And I think the other part about this on the permanent life insurance side of things is that like, I always say that it's not unique to it. People are like, well, you don't need to be audited. Like you can just borrow. Well, if you're not going to be able to get a home equity line of credit because your credit score is so low, you probably have no business borrowing, right? If you don't have any taxable investments that you can borrow from because too much risk, well, that's a problem. Or two, you don't have enough. Why do you have so much in the permanent policy over here? And then the other thing about it is the break-even period is long, right? On average, I see 15 to 22 years till what you put in, you're able to take out, right? So you have this huge build-up window where sure, you can surrender, but you're probably going to be 10, 20, 30, 50K in the negative if you get to that point of like, ooh, I want the flexibility to be able to start a business.
Yeah, definitely. And sometimes it's, sometimes it's 10 years, but the bottom line is the biggest issue is sometimes people are pitched this product and by the time they get to year 5, they forget why they bought it in the first place. They end up canceling it. So essentially they've overpaid for a term insurance policy, for 5 years. So I think you were getting ready to talk, Jacob. I didn't mean to interrupt you there.
I just feel like most whole life policies are a combination of a lack of education and poor planning, because a lot of the quote unquote use cases that I hear from people that are really trying to pitch whole life policies hard have a lot to do with somebody's situation if they didn't do planning right on the upfront, right? Their portfolio wasn't constructed the right way, minus the state taxes. But with the state taxes, I wouldn't recommend a whole life. With the state taxes, I wouldn't usually recommend a whole life policy because there's ways to get a higher death benefit at a lower cost to you.
So universal
so again, like
low cash value.
Yeah, I think there's just other options that are on the table that, again, if we have proper education around it and you understand what you're doing and you have good planning and good advisors around you, that you can get a better long-term result than just putting money in a whole life policy. I just hear a lot of these stories where it's like, oh, well, you could loan money against yourself and it's tax-free. Well, like newsflash, every loan in the history of the world is tax-free. Okay. Yeah. And the reality is like, the situation that I always bring up with any sort of cash value life insurance policy that I think most people don't think about is, okay, let's play this out. You're 65. Do you want to take out millions of dollars in loan? And they're like, well, they said that like when I die, it gets paid back. Well, yeah, sure. Technically it does. But like you still owe the money. Like it's a loan.
And it's the same way with my clients. I'm like, I don't really want you to sell your investments. I want, if you were a year or two away from a big goal, let's slow down investing and saving cash, right? Why generate the taxes to put money back in? It's the same thing here, right? Even though the interest might go back to you inside of that account, I can't think of a situation where somebody's like, oh my gosh, I need all this money, right? And if you did, you hopefully have everything in your financial plan designed where you have your emergency fund, you have money in your taxable account, you have contributions in your Roth IRA, you have reimbursements from your HSA. Like you have a lot of areas to pull money from. And then people are like, well, I borrowed against it and now it needs to lapse. Well, it still can become taxable, right? Now, like if it's above that basis, that still becomes taxable. And I think the other thing that we need to hit on here too is, again, people think that insurance salesmen will tell you all the time, life insurance proceeds are not taxable, but they're added to your taxable estate. So if you have the estate tax exemption is 10 million, I know it's not, but we're choosing a number, and you have 9 million of wealth and 5 million of life insurance, you got 4 million over the estate tax exemption and you're paying taxes, whether you view it as coming from a different vehicle or that one, it doesn't matter. You still have taxes. We can talk about ILITs, totally different time. Like that's the way around it, but it exists.
Yeah. I mean, I would say the biggest thing too is back to your kind of point about, okay, great. Like you bought this policy, say that you're funding it with a ton of money. You decide to kind of take advantage of one of these strategies. You borrow from the cash value. You're borrowing towards the top end of the cash value. So let's say that's 80 to 90%. You're doing that years down the road. You're taking money out above the basis. And then all of a sudden, like every year in business has been good up to this point. Now business revenue's down. You're starting to pull from some places. You're struggling to afford the premiums on the policy. The policy lapses. Then you're in a lot more hurt when it comes to taxes too. So it's just a very, very complicated option.
Totally. Okay, let's go into a couple of the others.
Yeah, so I think another one to touch on that's pushed very heavily. A lot of people would call it maybe the revolution of the IUL as an indexed universal life policy, which is a type of permanent insurance where the cash value of the policy is essentially based on an index. So it rides like an S&P. These types of policies typically have a ceiling and they have a floor. So the analogy that you're always going to hear from insurance people is it's like bowling with bumpers, right? You'll hear that a lot of times because you can't lose money in the stock market. And then there's a cap on it. The problem with these types of policies is that the cost of insurance in the policy can continue to go up, which can start to eat into the cash value. And again, the cost of insurance is going to go up over time, thus making the policy more expensive. And the policy is ultimately going to have less money in it.
Yeah, I was looking for this statistic. I found somewhere that it was like about 80% of IULs implode before that they're ever paid out, right? And that's because people stop putting money into it, right?
Yep.
And then cost of insurances go up. And if it's not that built up, you can have this whole issue. The other thing about it is, right, dividends don't get paid in those accounts, right? When you have an IUL, like if you look, right, like you don't want to just focus on dividends with investing, but at the same time, the S&P 500, it's like 40% of returns are derived from dividends getting reinvested. Well, when you have a permanent life insurance policy with this IUL, those dividends don't go back into the policy. So like you're going to have this issue. And a lot of times now people have this past decade as data. So like, look how great this IUL did against the best bull market in the world, right? And then, now you have people talking about whole life again as interest rates are higher, but right now we're going to a lower interest rate environment. Is that bull market going to continue in the same way? So if you're giving up dividends and you're also, still giving up quite a bit plus cost of insurance, you're not going to end up in as good of a spot. And like my thing here on all of this is like, is this needed, right? Like, why is this so much better? And you're like, well, 0%. Yeah, but if your investment time horizon is a long period of time, right? Your risk is very different, right? 1 year, 1 month or 1 day is like a coin flip. 1 year is about 75%. 20 years is about 100%, right? So like when you're worried about, I don't want down markets, you're really worried about, I don't want down markets for a really long period of time, which we haven't really seen besides 2000, right? Are we globally diversified? We have small caps, we have emerging markets. And then beyond that, I mean, the other thing that you want to be worried about is like sequence of returns risk. So like, is your portfolio designed in a way that like you're okay the first few years of retirement? Is avoiding negative years in the market really what you need? It's just a sales tactic, right? It's the same way why people only focus on dividends, because it feels good to know you have it versus having to sell and choose that income, even if that's a better route.
Yep. Not to mention, if you try to get out of them, usually the IULs have pretty significant surrender charges. So you're literally going to have to pay the insurance company within the first couple of years to cancel the policy. So if you don't have it in the cash value, so that's another downside of them.
Yep. Okay. What's the next one we should go through?
Yeah, I would say the other one that we should definitely talk about, and I think to your point, Jacob, that you were talking about earlier, is there's more efficient ways if there is an estate tax planning problem, is guaranteed universal life policies. So basically, this is not emphasizing the cash value. This is utilizing permanent insurance strictly for the death benefit. You're going to see a lot of times this is a lot more of an efficient way to actually mitigate that estate tax if that's what you're trying to do. So it's a guaranteed premium. You're going to be paying on a monthly basis. And those are a lot more straightforward and don't focus on the cash value. It's literally, for the most part, it's a death benefit play.
Yeah. Yeah. And I feel like that's kind of the one area I can see work if people are like, I want to have a policy for a lot longer, maybe kids are really spaced out and you're going to get older, or again, we need the estate taxes and term gets, if you want to get term once your policy ends now at 60, it's going to be really expensive. So this is a way to know you have permanent. And this is one where a lot of times people will do like a single pay, right? Like, hey, I just had a liquidity event. I'm 50 or 60. I'm for sure going to have this estate tax issue. We own a bunch of real estate and potentially other private investments. Great. Let's fund this, and guarantee that I have enough, but have no focus on cash value. Like we don't care about cash value at all. All we want is $4 million to cover estate taxes.
Yep. And beyond estate taxes, I will say the other time that we see this utilized pretty prevalently would be special needs planning. So if there's somebody in the family where inevitably upon your passing, there's going to be a level of care that needs to be paid for, this is a really good way to ensure that when you pass away, there's going to be tax-free money left behind. Again, it depends on the estate tax threshold and all that, like you touched on, but money left behind for them to be able to utilize.
Perfect.
Yeah, one other use case I would just say for permanent life insurance, and this is something that I feel like I've come around to more the more planning we've done, is if a client's in a situation where they just say, no matter what, I want to be able to leave my 3 kids $1 million each, and I don't want to stress about it. As long as we educate them as their professionals around, like, here's the different options that we could do to get to that point. And if they get educated around, they say, hey, you know what? I just really want to make sure that, like, I know if I pay X amount, this thing's going to happen, then I think permanent life insurance can be a good use case. And look, is it the most efficient way to get $1 million to each one of your kids? I would argue that in most situations, it may or may not be. But the reality is, if the client understands the pros and cons of it, and they're comfortable with it, and they have the money to do it, like, ultimately what we're trying to do is, no client gets an award for getting some crazy rate of return. They get a good feeling when they reach the goals that they want with the money that they have. And permanent life insurance can be a use case for that.
Absolutely.
Yeah, absolutely.
I don't think there's anything else. Probably.
I think those are the big ones. Yeah.
Okay. Perfect. Well, everybody, we appreciate you listening. Obviously, I think these are topics that we need to talk about. We need to learn about. Obviously, I think we went pretty deep here. There's a lot more maybe next year Broc and I will do, hitting on some other episodes. But we really appreciate you guys listening. Please rate and subscribe. And we'll see you back for next week with Broc on disability insurance.